We have seen oil prices really surge, even as some other commodity prices have backed off a little bit. Let's get the outlook for what could come next for oil prices and other commodities. Damien Courvalin is joining us now, Goldman Sachs Head of Energy Research and Senior Commodity Strategist. Damien, thank you for being here. As I mentioned, some other commodities, lumber probably most notably, has come off its highs a little bit. Oil just keeps marching upward. Where do you think we are in that oil trajectory, and how much further could we go higher?
Hi, Julie. We think oil prices can continue to move higher here. Our target is $80, but I think the risks for this summer are likely skewed to the upside. At the basic level, the oil outlook is one of a strong recovery in demand that we see across countries as vaccination progresses in the face of inelastic supply. And that's played out so far this year, but that will accentuate in coming months once the global demand recovery really becomes global. And so that will require higher prices to reflect two important shifts. First, increasing scarcity as we're eroding the excess inventory we had from last year. And second, the need to restart investments in upstream capacity. And that doesn't happen at current prices yet, hence the need for another leg higher in oil. But you do point out other commodities, and we do believe that they are further upside, copper in particular. Oil just stands out today because it is becoming physically the tightest market, and hence it's resilient when other macro events, like, for example, a shift in Fed focus, has rattled other commodity markets.
So, Damien, you talk about the lack of physical oil right now. Is this still kind of a hangover of sorts from what happened 5-6 years ago when there was a massive oversupply into the market where things shut down and, then we saw prices obviously would have bottomed to 20 or something like that. And now here we are back at $70 a barrel. Is that all part of the same cycle? And where does the industry go from here?
Yeah, so I think it's important to look at two angles here, right? So there is the inventory angle. We still have a bit of surplus from the shock of last year, but that's eroding quickly, right? We're in a significant deficit. Every day you're reducing that overhang. And we think by the end of summer, inventories will be actually lower than they were pre-COVID. So that's the first shift. That's your cyclical tightness just accentuating in coming months. The second one, as you mentioned, is kind of looking back at the last 5 years where as soon as we hit $60, we would always see a big surge in supply, mostly from shale. And that's been a dramatic shift where the industry has changed, right? After destroying investors' capital for the last 5 years, shale producers are now very focused on drawing investors again. And as a result, are less aggressive in spending in growing production. So that's the second shift. And that means that when you think about prices today relative to, say, the last 5 years, $70 doesn't mean the same thing, right? $70 has to reflect the scarcity, that's the physical angle. And second has to reflect this changed behavior of shale producers. 70 barely gets them started today. 72 years ago would have had them surging output in a matter of months.
Damien, perhaps I'm dating myself a bit, but I remember in 2008 when Goldman coined the term super spike as it pertains to oil. Do you think the stage is set for another super spike this summer, given how supply demand currently stands?
Yeah, so what was unique in 2008 was really the combination of a tight physical market, so that's similar to what we see coming this summer, but also this kind of lack of any future supply, right? We had seen a rally of 10 years and we were still looking for new sources of crude. We were exploring oil sands in Canada. We were testing shale, which at the time seemed like an eccentric technology. Today, we don't have that second component yet. I mean, a few years from now, with underinvestment, you can see that playing out. But today we have spare capacity from OPEC. We know shale can ramp up. We just have to get to that right incentive price. Now, you can still get a meaningful price appreciation because of the first driver, the physical reality, right? Oil is a basic necessities for all of us. And, we're going to pay for gasoline, even at a higher price than today. And when you enter this periods of low inventories, you tend to see meaningful price appreciation. It can be transient, and that's the overshoot above 80, for example. But again, that's what exactly lumber was. You have plenty of forests. In the short run, you didn't have access to lumber. And that's when you can see those material rallies Sometimes they're highly volatile, it can be transient, but nonetheless, it does create scope for that move higher this summer.
And so, Damien, as we think about all of the commodities, how should we think about the interplay between them and the Fed? And is oil really the one that might be more resistant to changes in not policy itself, but rhetoric around policy?
So at the base level, you have to go back to what the Fed said, right? The Fed said is, 2023, maybe we'll be raising rates. They haven't said we're hiking rates today to contain inflation. So they're doing nothing today to change what drives commodity supply demand. And that's key, right? When you think about a commodity market, what I care about is today's mismatch between supply and demand. In fact, if you guaranteed me there was a new pandemic in 2023, I would still have to be bullish oil because I'm looking at today's level of inventories, today's demand supply mismatch. And so what the Fed said has no impact on what drives commodities today. And that's especially true for commodities that are physically tight, as we discussed, and hence why oil outperformed the rest of the complex. For the others, it's come on the back of already a Chinese regulator focus on excess speculation in metals. So that's shaken some of the positioning. And the dollar has strengthened, which does matter to the cost curve of metals, for example. So, those two kind of shocks have led to a pullback, but they haven't changed the copper story at all. We think this is a great actually entry point for a commodity that's going to $15,000. But again, this market is not as physically tight as oil, and hence when those shifts in sentiment takes place, you can have the pullback that we saw in copper over the past month. Again, nothing has changed to the fact that copper will be needed in every step of the energy transition, and that no miner is building any new mine in copper. So 15,000 is still the path necessary for copper in our view. Just some volatility along the way when macro headwinds take place, like the Fed last week.
Damien, when I look at a broad overview of oil stocks, I would argue they haven't necessarily participated in this latest strong rise in oil. What's holding them back? And do you think the oil patch could break out?
Yeah, it's an interesting question because historically, when you come out of a recession, the equities always do well in excess of oil in terms of recovery because they're anticipatory assets. So if you expect eventually oil to rally, equities will always outperform. This time is different for two reasons. First, the last 5 years has seen oil companies destroy roughly half of all investors' investment, right? Whether it's on the debt side, on the equity side, with the sector lagging every other sector in the S&P in terms of returns. And so there is skepticism on the investor side to backstop the sector as oil prices rally. And that actually plays into the bullish oil view because it means producers stay disciplined and the supply response takes longer. That's the first reason. The second reason ultimately is as investors increasingly look at the world under the lens of ESG, they have to take into account the carbon emissions of the oil sector and, probably migrate some of their capital to, say, renewables, right? So, the capital allocation then follows, and producers have to exceed even their expected returns to draw those investors that are focused instead on, say, renewables. So there are really two challenges here. Now, as oil prices continue to appreciate and investors become more comfortable base casing higher oil prices, then sure, the equities should perform well. And our equity analysts on the oil names do have a significant upside in their coverage. But again, if next month when we get the earnings season, we start to see shale producers announce big capex increases to monetize the recent rally in prices, that would actually undermine the thesis for companies that are now being profitable again.
The temptation of those higher prices and to invest. It's hard to resist. Damien Courvalin, thank you so much. Good to catch up with you. Goldman Sachs Head of Energy Research and Senior Commodity Strategist. Appreciate it.